Good afternoon, everybody. Good afternoon, and welcome to the next instalment in the Admirals Trading Spotlight webinar series. Great to have you all here. Hope you're all having a wonderful week. Of course, we here at Admirals, we know that we have a truly global audience for our sessions. So wherever you are in the world joining us, you're very welcome, and we hope you're all well and making the most of this rather volatile year, which leads us on to our session for today, which is all about trading through bearish market conditions. Kind of lots for us to talk about there based upon what we've seen in terms of price action markets over the last couple of months. And of course, you know, you're, as I said, you're very welcome here. If you're watching this later on YouTube channel, then by all means, you know, you're once again, you're very welcome. Be sure to subscribe, okay, and give us a thumbs up if you're enjoying the content, or even if it's not, okay, if not to your thing, we don't mind a thumbs down. It's all feedback. And as always, just remember that at the end of this session, you'll be sent a very quick feedback form. We'd really appreciate if you just take 30 seconds to just fill that in, give you an opportunity to give you a, give you a voice about sort of telling Admirals how you're finding these sessions, and also gives you an opportunity to sort of say, you know, what if any particular topics you'd like to see from us in the future. So without further ado, why don't we cut to our future session, and let's start talking about trading through bearish market conditions. So just bear with me a second, and we'll just bring this all up and get started. Here we go. So, you know, as I said, I hope you can hear me. I hope you can see me. I hope you can see the slides for today. I'm going to talk about trading through bearish market conditions, something that many of you may have had experience of in the last few months. Okay, certainly in terms of how markets have worked and reacted, and something which might become more prevalent over the next year or two, based upon, let's say, the kind of current trajectories that we find ourselves on at this particular moment in time. Be interesting to know, okay, for the people here in the room, what, if any, experience you have from trading through bearish market conditions, whether it be through, you know, recent times, whether in other instruments or other classics, or maybe you've been trading that long that you've done it through sort of things, elements like the the great financial crash 2008, or dot-com bubble in sort of 2000, 2001, or even further back, if you're a bit of a an old market veteran. So as I said, trading through bearish market conditions is what we'll be talking about today. We are, of course, here Admirals, a Forex CFD broker with a wide range of instruments for you to trade, providing global presence with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, and allowing the opportunity to engage with markets using both the MT4 and MT5 platforms. If you have any questions about Admirals, please get in touch with your account representative, and they'll be very happy to help guide you. And also, you know, you'll also be able to find all of our best content here on the Admirals YouTube channel. What you'll be able to see is that look at there at Admirals Global, you'll find that all of the content from myself and the other contributors here at Admirals, you'll find it all there, okay, being able to sort of tap into a real wide range of topics and insights that will help you progress in your own trading journey. So what are we going to talk about today in terms of our agenda? Well, we'll talk about, you know, what does a bearish market environment look like? I appreciate that there will be some people who are new to trading and really won't even understand what that is, won't even actually have a real, will never have seen one, okay? Not in sort of like lifetime. So we'll talk a little bit about that. Not unsurprisingly, we'll talk about how it affects markets. What do we see? You know, how do markets move? How do markets react when they're sort of entering into kind of this bearish environments? And really, how does a professional trader navigate such markets? Right? Okay. Many traders are only comfortable, being in a long only environment, being in an environment where they actually just buy, whether that be equities, index, whatever, really. But what I've always said myself is that my view has always been that you should start out as your trading journey with the aim to be a versatile trader. namely the ability to trade any instrument on any time frame in any direction. Those are the kind of skill sets you want to acquire and want to operate with. And what you will find is that, over time, you will hone that down into the kind of the best areas that suit you, trading the sort of certain timeframes, instruments, directions that actually, work best for yourself. But to begin with, in terms of acquiring a skill set, then really you want to look to be a versatile trader. The ability to sort of, trade in any instrument on any time frame in any direction, to have at least that skill set as your baseline. So for those of you who don't know me, my name's Paul. I've been trading for many years, traded for hedge funds and for high net worth clients. Primarily, I look to focus on trading FX indices and commodities in particular, and I tend to be a trend trader for longer term trading, and I tend to be a mean reversion trader for shorter term intraday trading. So let's talk about how to trade in bearish market conditions. As the slide says there, ladies and gentlemen, we've seen unexpected volatility in financial markets in 2022. Some market analysts have described the beginning of possible bearish market conditions. But what actually are bearish market conditions? What actually are they? And that's what we'll talk about in the next few slides. And if so, do you know how to trade them? Do you know how to engage in them yourself? Do you know what you need to be aware of? So in this session, what we're going to talk about is learning how you can identify bearish market conditions and how you engage with them as a means of opportunity. As I said there just a few slides ago, I believe you should be a versatile trader, the ability to trade any instrument in any direction on any time frame. And also, what that does allow you is that allows you to turn, environments which many people might see as a threat, to be able to start to turn them into an opportunity. And I think that's, a good standard to have as a trader, okay, the ability to sort of turn any particular market environment into an opportunity. That's why we look to engage and operate in financial markets themselves. So, as I said, it'd be interesting to know what, if any, experience you have yourself. Do you actually even know what it means to be in bearish market conditions? Have you actually ever seen it before? I suspect probably some people who've operated in the crypto space over the last few years may have seen that in terms of bearish market conditions. But for those people operating in sort of, let's say equities and indices, generally over the last sort of 10 to 12 years, okay, really realistically, most people will not have really seen proper true bearish market conditions, and so there's something new for you to learn. So what is a bear market? So we talk about in trading, bulls and bears, all right? Bulls being associated with, bullish behavior, long behavior. Bears being, sort of associated with, shorting, with, markets decreasing. So, but if you were to look at what is actual bear market, as it says there, a bear market is sort of described to occur after a period of falling securities prices, and in particular, where prices have fallen 20% or more from the recent high. And that's really the kind of, let's say that's the standard that everybody operates to, is that namely, that the instrument, whether it be an equity, whether it be an index, whether it be a crypto, right, whether it be even whether it even be a currency, okay, or a bond, or a crypto, it's a case of where prices have fallen 20% or more from the recent highs. But what we do, as I say, is as I said, you could be labeling that across pretty much all asset classes. But what you'll find is most people are focusing on the sort of indexes and equities with that, all right? And they take a particular interest in that, especially on the US indices, all right? And the thing about bear markets is that they can last for weeks to years to even decades, it might be said, in certain particular instruments. You might look at that based upon some of the asset classes you might particularly be interested in yourself. As it said, it can apply to all financial securities, but traders and analysts in particular take keen interest in equity indices and the US indices in particular. Not really a surprise there, okay? Whatever you might think about the state of the world, the US economy is still the #1, okay, economy in the world, and with that, the US equity markets are the number one, the number one markets in the world, and so invariably the whole world looks to them for leadership, and it's a case of when and actually how those markets change and adapt and move. It's almost like throwing a stone into a pond, or ripples across the entire globe. And as we sort of move more and more towards, where we have kind of program trading, sort of from AI and algos operating in markets, what we tend to find is actually, we, in some respects, we're almost kind of moving towards almost like a spectrum of global indexes that all really sort of, follow each other. And by following each other, they generally just follow what's going on in the US market. So it's not a surprise that traders and analysts, not only in the US, but globally, take an absolutely keen interest in, in the equity indices, and the US indices in particular. As I just said on the slide before, that is where very often that is linked to the association with understanding, when we talk about entering bearish market conditions, most people will sort of associate that with what's been going on in the US stock market. So, I put this slide up here because it takes me back, takes me back to my youth, so to speak. A long time ago, ladies and gentlemen. But this is actually a chart of the NASDAQ in the daily running into March 2000, 22 years ago. There you go. What happened there, right? So the reason I put this chart up is that, this is actually one of the areas I started trading at during the dot-com bubble. We're into sort of, late 98, into 99, into 2000. And in some respects, some of the situation, or some of the environment, some of the factors were not dissimilar to what we find ourselves in here at the moment. Namely that, we had at that particular time, sort of a couple of months ago, back into certainly here in 2022, what we had was that, we'd had a, rising equity markets. We'd had, real new highs being formed on the NASDAQ and other American indices. But also what was happening was that we were starting to, the US Fed was starting to look at raising interest rates at a time when the actual economy was starting to sort of just run out of steam, run out of energy, running on vapors a little bit. And so what we started to get was, markets getting ready, sort of, they were running out of energy at the same time as the Fed raising interest rates and starting to look at, at tightening. And that is not dissimilar, all right? There are echoes, shall we say, than what we've actually seen, what we've seen sort of this year as well. And if I bring up my drawing tool here, I remember this very, very well indeed. As you can see here, okay, running at the end of 99, okay, into 2000, we had basically the NASDAQ sort of, rallying there, running up strongly. And, if you can look at it there, we were actually up to about 4,800 there into what was running into sort of the start of March, okay, into the middle of March. I think it was around about the 20th, 23rd of March, all right. And then what we had was the Fed hiked interest rates, and that basically also sort of started it was literally the top of the NASDAQ. And what we can see there is that invariably, the kind of the NASDAQ here, having hit 4,800, okay, in sort of March 2000, well, what we saw here was basically, by the end of the, a couple of years later, price was down, trading beneath 1,000, all right? So, people sometimes think that bear markets can never happen. People get used to markets always going up. I can assure you, ladies and gentlemen, that as this chart shows, that is not always the case. And in many ways here, just, we looked at is, this was into September, 9/11 occurred here, which many people sort of said was, the sort of start of a market crash. It wasn't at all, okay. In fact, it happened a couple of years earlier. That's what we were looking through there. That that crash had already occurred, and I remember the dot-com bubble crashed quite significantly. I was working in the industry and the environment at the time, and it was it was quite a it was a, how can I put it? For want of a better word, there was a fair bit of carnage going on there, especially if you were in sort of tech stocks, which if you look at how we're operating this year, it's not exactly dissimilar when we've actually had a look at some of the sort of the carnage that has appeared in some of those some of those particular tech stocks, which 2 years ago were the darlings of the market during the COVID lockdown, are now absolutely, just, collapsed quite a few of those big names, which we will look at later. But what I just wanted to show, as I said, was that, bearish market conditions do happen. Markets don't always go up. And there are lots of people who struggle to adapt. There's lots of people who find it very hard to short markets. Hence why, that's why I always say to traders, as I was saying earlier, learn to become a versatile trader. You might have a particular preference which develops over, years, but I think you need the skill set at least to be able to operate in all market conditions. You should be able to do that as a sign of a good trader. As I said, you will find your own edge, okay? You'll find your own niche, but to have the skill set underneath is a good starting point. So, there we saw what happened there in the NASDAQ, okay, back, 22 years ago, all right? And as I said, went from 4,800 down to over 1,000, okay, just over the next 2.5 years. So, there's, when a good bear market starts, as I said, it can run for weeks, years, and in some instruments, maybe even decades, depending upon the actual instrument. So never think that A, they can't go around, B, never think that they're just the quick things that turn around. They're not at all. They're not remotely. So what I have here is another example that I wanted to share with you. And the reason I want to share this with you is just to sort of, just give you, almost like a heads up, right? And what we're looking at here is a chart of the pound against US dollar on the monthly chart. Now, why would I be doing that? Well, some of you will be old enough to remember the GFC in 2008. Some of you, will be definitely very old, like me, who traded through the great financial crash of 2008. And of course, people associate the GFC with that kind of September, October period in 2008. That is when, people sort of, associate it in terms of when most of the damage or most of the major volatility occurred. But, what I want to make you aware of is that, these things, they don't just happen overnight, all right? It doesn't happen just like that, It could do if there was some, specific major event happens, or maybe there's a natural disaster, maybe there is a global nuclear event happen, right? Maybe something like that would occur. But generally, what happens is they don't happen overnight. These things occur they appear over a time. And this is a good example of here. This is, as I said, the pound against the US dollar on the monthly chart. And we can see here in 2006, we bottomed down and actually, really, through the start of 2006, all the way through 2006, all the way, okay, up to sort of August, September, the end of 2007, we were actually a really very good, strong trend. Okay, dollar was weak, sterling was strong. But then what we had here was, we had a really nice sort of a shooting star there. And actually what we can see is that the price rolled over, right? And the price rolled over almost like 10, 11 months before we saw the actual crash occur here. I'm sure you can sort of make it out for yourself, all right, here, when the real action sort of took up. As basically what we saw was, a flight into the US dollar. It was seen as a flight to safety at that particular time. And so you can see there yourself, I'm sure, ladies and gentlemen, of that chart from having traded, all right, from trading up around about 211, all right, towards the end of 2007. Well, we were down trading around about 130, all right, just about 18 months later, and that was how, the big event happened, the big rollover happened. It was, well, it was great if you were shorting sterling, but it was the move didn't happen just start off here. Okay, it actually started off almost a year beforehand, and that's a little point to take for yourself. Okay, namely that these things, as I said, they don't rarely occur overnight. The pressure has been building for some time, and then what happens is things happen quite slowly. And then everything happens very, very fast. And so as traders, it's in your best interest just to be aware of this phenomenon, just to recognize and understand it, so that you're in a position to prepare yourself, all right? And as I say, look at turning it from a threat into an opportunity. That's where we want to be as traders. And this was, exactly the same here. Okay, it's just another example of it in terms of this is the pound against the Japanese yen. So most of you will have been trading for a while will know that Japanese yen is normally seen as a safe haven currency. So, as I always say, capital is a coward. It will run and hide in the safest place at the first sign of trouble. And this was another example of it here, just pretty much like what we saw earlier, namely that really from through 2005, 2006 into 2007, we had a very strong trend there in the pound against the Japanese yen. But we peaked here, okay, in the summer of 2007. And then after that, we took our time, all right. We can see that actually the sort of the downtrend had already occurred, and that actually what we had was a little bit of a pullback here, a pullback into that 50, where we then saw the sort of, as I said, what's deemed to be the kind of the main couple of months of sort of, September, October of 2008, where, most of the damage was done. But once again, I hope you can just see that, the bearish market conditions had started, all right, over a year earlier. All right, over a year earlier, almost like 14, 15 months earlier. So as I said, the market is always communicating to you. It's always communicating to you. What it is it's your job to understand, okay, what the market's trying to tell you. And sometimes that takes a little bit of time to work out. Sometimes that's not always clear at first sight, which is why you're doing your analysis every week, every day, in order to put yourself into a good particular position. And once again, you can see there, right, from trading up towards like about 250, right, 250 yen to the sterling, we dropped down to around about 120, all right, over that sort of 18-month period. That's quite some significant drop that we saw there. So, as I said, these things occur, they happen. But they give you a good warning, right? They do give you a good warning that it's coming. You just need to be on top of your analysis to understand what is actually going on. And this was just another example of that period. Okay, there's a pound against the Swiss franc. Here, once again, remember what we're saying. Dollar became a safe haven during the GFC. Japanese yen is deemed to be a safe haven, as is the Swiss franc. And it's the same story. It's the same story that we've talked about here. Okay, these things they don't. It's not a unique phenomenon. All right, it has happened before. It will happen again. This is what occurs. And we can say that we ran it into 2006, into 2007, and we peaked there. Okay, summer of 2007. There, nice big monthly shooting star. And then you can see for yourself, right? We'd already accelerated, okay, in terms of sell-off, and then invariably what we saw was, this was around here, okay, where we started to get into the period of the kind of the real action in terms of the sell-off. And you can see for yourself that not only did we kind of crash during the kind of main period, but sorry, my rubbish mouse there, but what occurred was that I remember very well indeed is that we started to see continued strength in the Swiss franc. Swiss franc is is a safe haven. Swiss franc is deemed to be backed by gold. And so what we saw is, when everybody was a little bit fearful, people were piling into the Swiss franc, and invariably during that period, if you could look at charts there. Realistically, for that period there, just after the financial crash into sort of 2010 into 2011. Well, what actually really, all you had to really do was to basically buy Swiss franc and sell sterling, euro, dollar against it. And those trends were very, very strong, to the extent that actually the Swiss National Bank had to take action. And this is where you can see probably where here, that's actually where they pegged the Swiss franc against the euro at 120, because that was their way of, trying to stop the strengthening of the Swiss franc. The Swiss franc meant that strengthening of the Swiss franc meant that Swiss exports were invariably being damaged by that strength seen in the Swiss franc. So, Switzerland's exports, Toblerones, cuckoo clocks, Swiss Army knives, all those kind of elements and stuff, were invariably being damaged. Okay, their exports were being damaged, and so the Swiss National Bank had to step in and take some action on that. All right, and well, you can whether that was actually the right thing to do is another conversation for another day, ladies and gentlemen. But what I want you to be able to take away from here is that before we had a real market meltdown, that actually the markets had kind of reversed and started rolling over already a year or so beforehand. And as I say, that has happened before. That will happen again. This is your opportunity to sort of as I say, turn it from a threat into an opportunity. So, what do traders need to be aware of in such environments? What do they need to take into account? Well, I've had personal experience. All right, I was very fortunate, okay, to do well out of the dot-com crash, but that was just luck. It wasn't me being a good trader. I was just a very lucky punter at that particular time. But what that did do is it allowed me to sort of, continue working on building up my trading experience, and then trading through the JFC, it's trading through such things as Brexit, etc. Gives you a little bit of experience, okay, about what happens during these events. And as I think I said a little bit earlier, what you tend to find with these events is that things happen very, very slowly, and then everything happens very, very fast. Everything happens very quickly. And that is not always easy to recognize, especially if you're a new trader. Not always easy to engage and operate with it, because invariably you're just trying to understand what is actually going on within that particular market itself. But as a general rule of thumb, to work with, what we see is that financial markets, they tend to drop 3 times as fast as they climb. There's the old stock market adage of a bull climbs the stairs and the bear jumps out of the window. And that is very apt, along with market set stairs up and the elevator down. All right. There's lots of these old, let's call them, financial markets trading cliche, and they actually do have they have a basis of truth, right? There is a grain of truth in there. And that's what we see, is that, markets can basically take a long time. They can take 3 years, climbing, and in 1 year collapse all of that previous price action, all that kind of previous gain that can be sort of, given up in a very short space of time. So, as I said, things happen slowly and then happen very, very quickly. But that is, and hopefully as we saw in those charts there, that provides opportunity, right? That provides opportunity for educated traders, and that's one of the things we've always been trying to do. The Trading Spotlight here is enable you to be educated, to provide our own insight from our own experiences that allows you to be prepared, to forewarned is forearmed, as we would say here in the UK. And there is truth in that, being able to understand and see and talk about these sort of these environments. Well, that can enormously help a trader in terms of not being intimidated or not being fearful about these environments. It's about recognizing that actually this could provide opportunity if I'm properly educated and properly focused and have the correct resources. This can then become an opportunity for me. And certainly I've learned that myself. I love trading volatile markets like this. I love trading and sort of understanding the kind of the volatility that we see that comes with such markets, and being able to short markets. I know myself, I have a bias towards shorting markets anyway. That I normally have, normally about 2/3 of my trades are shorts, and that's just, I see the setups very, very, very easily. They sort of leap out for the chart at me. Okay, I feel like I'm ready to sort of swoop in and do my business in markets. That's the way I like to operate. And so as I say, with a little bit of education, a little bit of experience, a little bit of insight, you can start to turn these environments from intimidating, fearful environments into one that provide opportunity for you, to grow as a trader in every sense of the word. So, how exactly can you start to turn this into an advantage? How exactly can you work with this to make these things better for you? Well, what we can do is, firstly, be able to identify when markets are becoming tired, when they're becoming overstretched. Now, some people would say that that they might particularly like to use certain indicators, perhaps oscillators, that would give you maybe an overbought or an oversold reading. And I wouldn't necessarily discount them, but I wouldn't personally make them the let's say the kind of the primary indicator for myself. What I have always stated, that being able to do good analysis on good price action, that in itself will help you start to identify when markets are starting to become tired, when they're starting to become a little bit stretched. And we'll look at live charts in a moment, just to sort of give you some hints and some ideas on that. But good analysis, okay, done consistently, understanding of price action, that will help you, okay, on the higher time frames, that will help you to begin with. And yes, there might well be oscillators that people like to use, okay, maybe things like RSI or stochastic, etc., which might be, looking at an overbought region, and perhaps maybe even a divergence, okay, as markets start to become stretched away and there's a divergence between the price action and the indicator. That is a way that you could look at that. I think, I try to get across to traders that trying to pick exact tops and bottoms in markets is generally a pretty futile task. You'll get it right on occasion, and you will love getting it right on occasion. Your ego will love that experience. But very often, especially as an inexperienced trader, if you're new to trading, if you do call the top, well, then it's more likely to be luck than judgment. All right. What is actually more useful to you, I believe, and what is actually more beneficial and what is more feasible and more sustainable, is to be able and quick to identify when the market is changing. Markets do change, they do go through transitions, and you might not necessarily be able to sort of identify the exact top or bottom, but once again, with good analysis, okay, good kind of understanding of price action, well, then you can start to identify when a market may be changing. So this might be that, having made a recent high, the price then just makes a lower high. Price can no longer make, all right, a new high. Maybe it makes a reversal pattern, maybe a double top or a triple top, all right? Maybe it's a head and shoulders pattern that you start to see that is actually occurring. So calling this, trying to call the exact top is pretty futile game. But being able to identify understand when a market is changing, that is useful information. That can help you, okay? That can help you reposition yourself if you've been long. You might want to just pare down your positions and then get ready to reposition yourself should that market roll over, crack, and break. And prepare to recognize when markets are in an official bear trend. And, don't worry about having to work that out. I can assure you the financial media will be all over that, okay? They'll all over like a cheap suit. They'll all be, wanting very quickly to sort of, to basically write headlines all about how we're into bear market conditions. So you don't necessarily have to, measure each move to the exact date. I can assure you that the MSM, the sort of financial media, they will be wanting to talk to you all about it. And, finally, we'll find ways to trade new trends in bearish markets, which is, is common sense, really, but I find that many often people forget that, all right? And and what you'll find is that if you're a trend trader, being able to trade good uptrends, those skills should also be able to sort of be displayed when you're trading bearish trends. And we'll talk a little bit about the difference, the subtleties of bearish trends over the next couple of slides and pictures. So there is a couple of things that you can start to take away, start to look at in terms of what you need to be aware of, what you need to be working on in terms of being able to turn this to your advantage. So here's an example here, okay? So it's present, this is the present day, this is the Dow Jones, okay? The weekly, the Dow Jones weekly chart here. Let's get the old drawing tool here. Now, for those I do a little bit of a Monday market update lunchtime session, and always looking at these markets and identifying trends. And what we can see here is that, really after Biden's election, okay, we were in a very good uptrend. We were in a very good uptrend. And what was also useful to help us was that, the 20-period moving average was acting as good support, okay? But what we can see is, remember I was saying, trying to pick the exact top, all right, is not always the smartest move, because invariably, on the way up, people might say, oh, that was the top, or 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 that was the top, until you actually do finally realize that this particular here at the start of 2022 was the top. And what we're starting to see, as I say, is that, it's more about identifying that the market is changing and being ready to adapt to that. Trying to pick the exact top, good luck with that. But being ready to adapt to how the market is changing and recognizing, well, that is very, very useful. And we see here in this particular case in the Dow Jones, it made a high at the start of 2022, and then what we saw was price actually break through. All right, it broke through the recent high, the recent lows, and then when it rallied, it could basically not rally higher again. Okay, what we had was basically we had, effectively a lower high. And what we saw here was that, the 20 period moving average, which acted as support on the way up, now flipped. Okay, it flipped and started to become resistance. All right, and that's what we started to see. We started to see the wicks, wicks that were all on the downside. Okay, wicks which were showing, bullish buying pressure. Wicks were now changing, flipping to the other side, and they were showing selling pressure. And that's what we've seen here. Okay, we've moved down. We've basically made lower lows. Then we've come back up here. All right, price here, and this was a great space to actually trade around here. Lots of us were getting short here because now we're now making, okay, we're going to making lower highs, and bosh. Here's what we did then. We've made lower lows, lower highs. Now, what you might have noticed is this particular candle here from last week. We had a real bullish bounce there, right? Real bullish bounce in the Dow, in fact, across all of those US indices, which meant we got a bit of a bullish bounce across all of those indexes, globally, really. That's one of the kind of the nuances that you need to understand in terms of bear markets, namely that, even within bear markets, you might actually have mostly quite bullish days. And sometimes you will have, really very, very strong bullish rallies, right? Bullish rallies that will rip your face off if you're not really prepared for them. So even if you might be short and looking to sort of trade in those bearish market conditions, don't be surprised if you get very strong bear market rallies. That's because, for some people, every time, let's clear this here, shall we? Every time, we make new lows here, every time we make new lows, well then, long-term investors, they may be seeing that as an opportunity to buy the share or the index or the instrument on the cheap. And that's what they'll look to do. And they'll have, they'll be sat positioned on the side, able to sort of trade into that. Whereas, sort of shorter term traders, swing traders might be looking to sort of, as I say, to short that, because we can see that we're in a bearish market moving down. Well, then invariably what we can see is that there will be some people, who might have, a 10-year, they may have a 10-year timeline on their investment, who might think that actually, the Dow or whatever is cheap at that level. That is where they want to do their business. So hence why, when you do get, as I say, a bear market rally, it can be very, very strong. Okay, it can, to use the old trading adage, it can quite quickly and easily rip your face off if you don't really understand what you're doing. As you can see here, that week there was very strong. The week before, last week was very strong as well. And what we'll be looking to see now is, well, actually, will that continue, or will that actually just run out of steam and start to roll over again and go down to making new lows? And I think if it does roll over and fall away, well then, really, I think you're looking at the big round number of 30,000 to particularly move towards. And even if we just look at the S&P 500, it's a very similar picture. Remember what I was saying is that, these things, they don't happen overnight, all right? They don't happen over the market's always communicating to you. This S&P 500 weekly chart is in an absolute glorious uptrend, same as the previous one, namely that, we can see that basically, we were making higher highs, okay, higher highs, higher lows, the 20 period moving average, which is the blue one on my charts, acting as a nice support. And then what we got here at the start of the year, this is a bearish engulfing candle. In fact, we actually had one a bit earlier, okay, in November. That was giving us a hint that market was, running out of steam, running out of energy. But then got a second one, right? And what we saw was, a bit like the last time, is the price rolled over, broke the previous lows, put in a new low, and then when it tried to rally back, was unable to make it past the 20 period moving average. So now what we have is, we have that lower high, and then we go for another lower low. So we're getting, lower highs, lower lows. We rally up here, and we probably scare a few people out here when it just tries to push above that, but then it immediately turns into an evening star formation. If you don't know what that is, you'll find that there is the video on that in the Admirals YouTube channel. So be sure to pick up on that and take a look. And what we can see is, we dropped very, very strongly there. And interestingly, we dropped around big round number of 4,000, okay, which we had closed the week before. And then, a bit like the Dow last week, we rallied very, very strongly up, okay, above 4,000, big round numbers. These big round numbers, they become, very key. They become very important because the whole world is looking at them, right? It becomes a line in the sand. And a bit like what we said on the Dow there, right? You can have very, very strong, bear market rallies. And when that does occur, just be careful and just be ready and just be aware that that will actually, happen. And I just thought, even though we looked at the couple of the indices, it happens in particular, in particular instruments as well. So this is, the juggernaut that is Amazon, and you can see for yourself that, after the kind of COVID collapse, well, we certainly did have an absolutely fantastic, strong trend there. The price really went kind of sideways there for about 15 months. Every time it popped out, came back in, popped out again, making a double top. We had a double top there, remember, kind of reversal pattern there before we kind of drifted down to the bottom end of the range, kind of rallied back up. And, in the same way here, the 50 period moving average, which has acted as support, very strong support there, all the way on the way up. It flips, and now it's starting to point down. And what we have is that, it goes from being support to resistance. And then what we have there is, is a really nice pin bar, sort of pinning that 50 before we kind of price absolutely collapse. So it's not massively dissimilar to those American indexes, big juggernauts like that, they start to reflect the indices, but, they are all tradable, and you can trade them through the Admirals platform there. So, these charts here, and I would suggest that maybe the indexes haven't closed in bearish market conditions, but, you can certainly look at things like Amazon and some of the other bigger stocks to see that, they have dropped 20% from their recent highs quite significantly. And, and they themselves are tradable opportunities. Another one is Tesla, all right, Tesla, which has been a darling, a darling of the last few years. And we can see that from being down there, at the COVID crash, we had a real rally up. What we had there was, head and shoulders formation before it came down. But once again, the 50 was acting as support until we reached those highs at the end of last year. And then what did we do? We rolled over, and we're making lower highs and lower lows. And, we just recently once again made a lower low. Now, of course, this is just also, Tesla is also impacted by, what's going on with Mr. Musk and Twitter. But the price action is letting the price action is rolled over, and there was opportunities there, and it wouldn't be surprised if we did have a bear market rally back up to that sort of 900 area there where the 20 and the 50 are, and then you'd be looking at, if it rolls over, if it moves, well, could it move down to sort of 500? That's where you might be looking at. So, as I said, price never moves in a straight line. There's always a zig and a zag. And if you can identify those bear market rallies when they occur, well, then you can be, ready to sort of, take advantage of them as they particularly run out of steam. So, as I said, what you need to be aware of, right? So when markets start to turn bearish and start to look like they're going to be trading bearish wise for what might be at least a few months, you need to basically, you need to be looking to sell breakouts to new lows. That's when, you can do that. Or, as I would like to do, sell the rallies, okay? But just remember, beware of strong bear market rallies, okay? They can literally on a day, absolutely, as I say, rip your face off in terms of trading terms, because it's so strong. But you just need to be aware of that. That's part of the way bear markets differ from long markets. In terms of what tools you can use, well, you can use, all the tools that we've talked about in many of the other Trading Spotlight webinars, namely, trend lines for support resistance breaks, moving averages, where I was showing you there where the 20 and the 50, how they can flip, breaks of support, and also, just using good price action, that we've talked about in the past to help identify the end of trends, to identify the end of rallies, and also how price maneuvers itself on new announcements. And that can be new news announcements, because as sort of bad news comes out in the market, everybody wants to get their skeletons out of the closet. That's what actually can come in, and that is what can actually cause all sorts of further strong moves to the downside. So in conclusion, ladies and gentlemen, bearish markets provide opportunity for prepared traders. Bear markets are deemed to exist when a market has dropped 20% from its recent high. They can last for a matter of weeks to decades. bear markets can be and will be volatile. So just remember those, bear market rallies. But once you've identified them, then you can trade them with several of the different tools that we've talked about, and the videos of which are in the Admiral's YouTube channel. We've just got a minute or two left, so I'll quickly switch across to the live markets, right, just for the last moment or two. But as I said, if you want to get in touch with us, you can see us there. Email at global@admiralmarkets.com is the best way. And as I said, this video will be on the YouTube channel, and also on the Facebook channel /Admirals Global. Okay, so just bear with us one moment. We'll just very quickly switch. We've only got a minute or two and stuff, so just bear with us, and then we'll run out. But here we go. Hopefully, we should be able to bring up our Admirals chart. And really, what I'm just looking at there is, we've looked at here we go. We've looked at the Dow. We looked at the S&P. But equally, if I look at NASDAQ here, the NASDAQ is telling the same story, okay, and it has been. We had a great run up, absolutely fantastic trend, all right, okay, basically making new highs, higher lows, okay, which was supported by the 20-period moving average, and then we ran away, okay, we pulled away, market got tired, printed a bearish engulfing candle, bearish key reversal, which became a double top. And then we started to sell, okay? And then once we start to sell and get beneath the 20-period moving average, turns out it rolls over and it flips from being support to resistance, and that's what we get there. And there was a beautiful spot there, okay? To be short the NASDAQ there, it was an evening star formation, it was a shooting star formation, domino candle, sort of up against the 20 and the 50, both acting as resistance, and you can see the price basically collapse there. Like Dow and S&P, we had a strong week last week, and it wouldn't surprise me if that continued. Okay, what we'll see up to at least into the kind of 13,000 area, 13,250 area, and then once again, I'll be looking to see, will that be then a rally that we can sell into? Will that then show us if there is that bearish market is to continue and be officially confirmed for itself there? So if we look at that, okay, so that was a kind of NASDAQ there. That's what I mean. Quite a few of them have already moved. Even the mighty Google, okay, on a weekly chart in a super trend last year. Hopefully you can see there. But we topped out there. Wasn't particularly the kind of the clearest picture there, but that's sometimes the case. But what we can see is that once we've made that kind of high, we started to roll over and we started to make lower highs with evening star formations before price absolutely collapsed and dropped. We've had a bit of a pullback last week, but what we need to see is a bit of it needs to be a much stronger one to confirm that that kind of trend is over. So what we'll do is be waiting to watch that over the next week or two to see how things like markets, NFP, or other numbers come out that basically sort of give us an indication of which way we're going to see for the rest of 2022 in terms of whether those bearish market conditions will continue for the rest of the year. So there you go, ladies and gentlemen. Unfortunately, we've run out of time there as always, but I hope that's given you just a little bit of a heads up. I hope that's given you just a little bit of insight in terms of what you need to be aware of, okay, as markets become bearish, and what it is, how you can do, what you need to be aware of and what you need to look at to turn it from a threat into an opportunity, because as I've said all along, there can be a fabulous trading opportunity if you are properly prepared and properly understand what you're actually experiencing. So as always, it just for me, just to end up by saying that I wish you all of the best of success in your own trading endeavors. I hope you have a fabulous trading week, ladies and gentlemen, and I look forward to speaking to you soon. Trade well, everybody. Cheers.